You've likely heard the term bubble being thrown around when discussing financial markets. But what exactly does it mean, and why is it relevant now? A financial bubble refers to an economic cycle characterized by the rapid escalation of market value, particularly in the price of assets, followed by a contraction. In simpler terms, it's when asset prices rise significantly, far above their intrinsic value, only to eventually come crashing down. Currently, we're in unprecedented territory. Central banks, including the U.S. Federal Reserve, the European Central Bank, and Japan's central bank, have been printing money at staggering levels. While this initially helped stabilize the economy during crises like the pandemic, it comes with risks. Historically, when countries print excessive amounts of money, inflation rises and economic stability can be severely threatened. The longer we go without addressing these issues, the more likely we are to face severe consequences. To understand the potential dangers, we can look back to the 1970s, when the Federal Reserve Chairman Paul Volcker raised interest rates to 20%. It triggered a deep recession. The economy endured massive unemployment and high inflation, known as stagflation. While Volcker's actions eventually controlled inflation, the process was painful. Today's situation is unique. The economic and political environment is different, making it unclear whether a Volcker-style approach would work. There's no guarantee that politicians will allow the kind of tough economic measures necessary to rein in inflation. The question remains, what could the next economic downturn look like? As we see nations print more money, the seduction of paying off debts with free money becomes irresistible for governments. However, this comes at a high price. Excessive money printing leads to inflation, which can erode the purchasing power of your savings and investments. Think of countries like Argentina or Venezuela, where inflation has spiraled out of control, leading to severe economic crises. The truth is, we are flirting with danger. The more we print, the greater the risk of losing control. For investors, this should be a wake-up call. We must prepare for the possibility that our money could lose significant value in the future. One of the more interesting developments in recent years is the rise of passive investing. Index funds, which passively track major stock indices like the S&P 500, have grown massively in popularity. This shift has given more power to large institutional investors who manage these funds, like Vanguard and BlackRock. While passive investing is often lauded for its simplicity and cost-effectiveness, it comes with its own set of risks. These institutional players now hold significant voting power in corporate governance, which could have far-reaching consequences. Moreover, the sheer amount of money flowing into these funds has led to inflated stock prices, creating potential bubbles in the market. Another critical trend shaping the future of investing is automation and robotics. As industries worldwide become increasingly automated, there will be significant disruptions in the job market. Companies that rely on human labor may find themselves outpaced by those that adopt robotic and AI technologies. This shift brings both challenges and opportunities for investors. On the one hand, investing in innovative tech companies can offer substantial returns. On the other hand, industries and workers that fail to adapt may face significant economic hardship. If you're an investor, now is the time to start thinking about how technology and automation will shape the future of businesses. Look for companies that are ahead of the curve in adopting these advancements, as they are likely to thrive in the coming years. Throughout history, governments facing economic challenges have often resorted to printing more money to solve their problems. While this may provide a temporary fix, it comes with long-term consequences. One of the most infamous examples is Germany in the 1920s. The Weimar Republic printed so much money to pay off war debts that its currency became worthless, leading to hyperinflation. This economic collapse helped pave the way for the rise of Adolf Hitler. Today, the United States and other major economies are walking a fine line. Politicians are tempted to keep using monetary policies to address short-term problems without considering the long-term risks. As citizens and investors, we must be aware of this pattern and prepare for the potential fallout. One of the most common questions in times of economic uncertainty is whether to hold cash or continue investing. Historically, holding cash for long periods has not been a successful strategy for building wealth. The value of cash erodes over time due to inflation, while investments, especially in high-quality stocks or real estate, tend to appreciate. Even in challenging economic times, finding the best investment opportunities remains a smarter strategy than hoarding cash. For instance, Warren Buffett's Berkshire Hathaway holds cash, but only because it cannot find attractive investments at reasonable prices. This isn't a timing strategy. It's about being patient and selective with investments. The lesson here? Don't sit on the sidelines waiting for the perfect moment. Instead, focus on finding strong investment opportunities that can withstand inflation and market volatility. The market has become increasingly unpredictable due to massive liquidity, speculation, and institutional investment strategies. Many companies today are overvalued, driven not by strong fundamentals, but by speculative investments and automated trading. However, great investment opportunities still exist, especially for long-term investors. Companies like Costco, which has a strong business model and loyal customer base, remain solid investments even at higher prices. If you're investing for the long term, focus on companies that provide essential services and have a competitive advantage. Inflation doesn't just affect your wallet, it can have serious political implications. Throughout history, rising inflation has led to political unrest and instability. In Latin America, for example, inflation has often led to regime changes and economic chaos. Even in the U.S., there is concern that prolonged inflation could lead to political instability. As inflation continues to rise, governments must carefully navigate these treacherous waters. Overprinting money and taking short-term solutions may lead to long-term instability. As investors, we must stay vigilant and prepare for all scenarios, including the potential for more dramatic political and economic shifts. The world has seen extraordinary advancements in technology, healthcare, and living standards over the past century. However, despite these improvements, many people feel less satisfied with their lives than ever before. This phenomenon is largely driven by envy and social comparison. While we're better off financially and materially than previous generations, we often focus on what others have, which fuels dissatisfaction. As investors, it's crucial to avoid getting caught up in this mindset. Instead, focus on the fundamentals: saving, investing wisely, and avoiding unnecessary expenses. Investing in quality assets like equities, real estate, and stable businesses can help secure your financial future. Inflation is a complex issue, and there are no easy solutions. However, individual investors can protect themselves by focusing on long-term strategies. Investing in high-quality companies, real estate, or other tangible assets can provide a hedge against inflation. Diversification is also key. Don't put all your eggs in one basket, but at the same time, don't feel pressured to over-diversify. Having a few strong assets is often better than spreading yourself too thin. Finally, remember that investing is a long-term game. The economy will go through booms and busts, but those who stay the course, remain patient, and make informed decisions will likely come out ahead in the end.